All right, so get this. We're going to do a deep dive into Warren Buffett's crystal ball
Oh, wow.
back in 1999.
Okay.
Yeah, we've got these excerpts from this Fortune magazine article, and he's basically laying out all these thoughts about where the stock market's headed.
Interesting.
And the thing is, this is like the peak of the 90s boom,
Right.
and he's already seeing all these warning signs.
Uh-huh. It's almost like he was looking at a completely different market,
Yeah,
than everybody else.
totally.
So I guess in this deep dive, we're going to try and figure out why he was so skeptical.
Yeah, like what was he seeing that everyone else was missing?
Exactly, and especially about whether those incredible stock returns could really keep going.
Well, yeah, because, I mean, think about it. Back then, the Dow Jones was at a measly 874
Oh, wow.
on December 31st, 1964.
Okay.
But by the end of 99, it had shot up to almost 11,500.
Huge.
Yeah. So were people just completely caught up in the hype? Or was there something real behind all this growth?
I mean, there was definitely growth, but Buffett argued it was all fueled by something that just wasn't sustainable in the long term.
Like what?
This massive drop in interest rates.
Okay, so hold on. If interest rates are dropping,
Oh.
wouldn't that make borrowing cheaper?
Mm-hmm.
Which leads to more business activity and ultimately like higher stock prices,
Right.
right?
Right.
So why would Buffett see this as a bad thing?
That's a great question, and it kind of gets to the core of how Buffett thinks,
Yeah.
He wasn't necessarily denying that there was this short-term boost,
Right.
but he was looking at the bigger picture, the long game.
Okay.
He was worried that this drop in rates was artificial and temporary, almost like a sugar high for the whole market.
So he saw this as a big warning sign.
Yeah.
Like, enjoy the party while it lasts, but don't expect it to go on forever kind of thing.
Exactly. And it wasn't just interest rates that he was focused on.
What else?
He was also keeping a close eye on corporate profits.
Okay.
He believed that the unusually high profits that companies were making as a percentage of GDP, you mean like they were getting a bigger slice of the overall economic pie?
Right?
So wouldn't that just mean that they were doing really well?
Well, on the surface, yes.
What was the issue then?
His concern was about whether it was sustainable.
Okay.
He pointed out that these profits were at historically high levels, and he doubted that they could stay that way forever.
So basically he was saying, don't get too excited, folks. This profit boom might not last.
Exactly. And he even predicted that the U.S. economy wouldn't grow at a rate exceeding 5% annually.
So he was thinking that corporate profit growth might slow down as well.
Right, because if the overall economy isn't growing that fast, it's hard for companies to keep increasing their profits at the same pace.
But weren't companies also doing things like stock buybacks back then to boost their earnings per share?
Right.
So wasn't that another way to kind of keep the good times rolling?
Yeah, that was definitely happening, and Buffett was very aware of it.
Okay.
He saw those buybacks as kind of a cosmetic fix.
He even compared it to a company putting on makeup to look more attractive,
Interesting.
but not actually addressing the underlying issues.
Right.
So he could see through that tactic
Yeah.
and recognize that it wasn't a real substitute for genuine business growth.
But wasn't there like a totally different perspective back then?
Oh, absolutely.
Like think about someone like Jeff Bezos, right?
Yeah.
Who was all about disrupting industries and riding that tech wave.
Right.
They must have had very different outlooks on things.
Oh, for sure. There's actually a great anecdote where Bezos asks Buffett for his list of automatic losers in the market.
What?
And you know what Buffett says?
What?
He basically predicted that internet companies wouldn't succeed.
Wow. So while Bezos was betting on the future of tech,
Yeah.
Buffett was sticking to his guns, focusing on companies with solid fundamentals
Right.
and, sustainable competitive advantages.
Exactly like those classic car manufacturers that were able to survive while others went extinct.
Yeah, so he used the auto industry as an example to show that even though it transformed the world,
Yes.
only a handful of companies actually made it through.
Right.
And he saw the same thing happening in aviation, too.
Yeah, for him, these were like cautionary tales for the whole .com era.
It's like he was saying, don't be fooled by the shiny new thing. Focus on what really matters, which is enduring value.
Exactly.
But how did he think investors should actually find those companies?
Well, Buffett had this really interesting analogy.
Oh, is this one about horses?
You got it.
Oh, yeah, I've heard about this.
He compared the decline in the U.S. horse population
Oh,
to the shrinking number of publicly traded companies.
okay, I'm intrigued.
Mm-hmm.
Tell me more about this horse analogy and how it ties into his whole investment philosophy.
Well, he noticed that as industries consolidated, fewer and fewer companies were dominating the market.
Okay.
And that meant fewer opportunities for investors to pick those winning horses, so to speak.
Ah, so it's not just about finding great companies.
Right.
It's also about recognizing that the playing field itself might be shrinking. That's a pretty thought-provoking idea.
It makes you wonder if the same forces are at play today.
Yeah.
Especially with these tech giants becoming so powerful.
Right.
But before we jump ahead to the present, I think we should dig a bit deeper into those specific factors Buffett was worried about back in '99.
Okay.
We talked about interest rates and how he saw that drop as unsustainable.
Uh-huh.
But what specifically did he think would happen?
Well, if I remember correctly, he was concerned that those low rates were artificially inflating stock prices.
Right.
But wasn't he also worried about corporate profits?
Yes.
Like something about them being too high relative to the overall economy?
You're exactly right. He believed that those sky-high profits couldn't last forever.
Hmm.
He even went so far as to predict that the U.S. economy wouldn't grow at a rate exceeding 5% annually.
Okay.
So essentially, he was saying that if the overall economy wasn't growing that fast,
Yeah.
corporate profits would likely slow down too,
Okay.
eventually putting downward pressure on stock prices.
So it's like he was looking at the whole picture,
Exactly.
not just individual companies.
Right.
He was saying, hey, even if a company is doing great,
Uh-huh.
it can still be affected by these bigger economic forces.
Exactly. He understood that everything's connected.
Right.
And that's why he was so wary of those short-term tactics companies were using to boost their earnings per share,
Yeah.
like those share buybacks we discussed earlier.
Yeah. He saw those as a way to dress up a company's financials
Right.
without actually improving its underlying business.
Exactly.
It's like putting lipstick on a pig.
I love that analogy.
Right.
It might look better on the surface, but it's still a pig.
Exactly.
And it highlights the importance of looking beyond the hype
Yeah.
and focusing on those fundamentals.
Right.
Buffett believed that genuine business growth was what ultimately drove long-term value,
Okay.
not these financial engineering tricks.
But wouldn't some people argue that those buybacks were actually beneficial to investors?
Oh, sure.
Like, didn't they increase the value of their shares?
That's a valid point, and there are definitely arguments to be made on both sides.
Okay.
But Buffett's concern was that these buybacks were often done at the expense of reinvesting in the business,
Hmm.
which could hurt long-term growth.
Right.
He preferred to see companies using their profits to expand their operations,
Yeah.
develop new products,
Mhm.
or make strategic acquisitions.
So it's a question of short-term gains versus long-term sustainability.
Exactly.
It makes you wonder if today's market is facing similar challenges.
Right.
I mean, we've seen a lot of companies pouring money into stock buybacks in recent years.
We have.
Is that a sign of a healthy market or a potential red flag?
That's a great question, and one worth exploring for sure.
Yeah.
But I think it's important to remember that Buffett was writing this back in 1999,
Right. Yeah.
at the height of the dot-com bubble.
Yeah.
And the market landscape has changed significantly since then.
It's a completely different world now.
It is.
Back then, people were throwing money at any company with a .com in its name. Today, we've got things like artificial intelligence and blockchain dominating the headlines.
Right.
I wonder what Buffett would make of all this.
Yeah. It's fascinating to think about, isn't it?
It is.
Would he see these new technologies as automatic losers,
Yeah.
like he did with those early internet companies?
Right.
Or would he recognize their potential to transform industries and create lasting value?
That's the million-dollar question.
It is.
But before we get too caught up in the present,
Yeah.
let's bring it back to those specific predictions Buffett made
Okay.
about interest rates, corporate profits, and GDP growth.
Right.
Like, how did those actually play out over the past couple of decades?
Mhm.
Did his concerns materialize?
That's a great question.
Yeah.
And it's one we should definitely unpack.
Okay.
It's time to see how those economic forces have played out in the real world.
All right, let's take a trip down memory lane and see how Buffett's crystal ball measures up against reality.
Let's do it. He noticed that as industries consolidated, fewer and fewer companies were dominating the market. Right. And that meant fewer opportunities for investors.
Yeah.
To pick those winning horses.
To pick those winning horses.
Yeah.
Yeah, so it's not just about finding those great companies.
Right.
It's also recognizing that the playing field itself
The landscape's changing.
is shrinking.
Yeah. Exactly.
That's a pretty thought-provoking idea.
It makes you think, like, are we seeing the same things today?
Yeah.
You know, especially with these tech giants becoming so powerful.
Yeah, totally.
But before we get too far ahead of ourselves,
Yeah, let's go back.
let's go back to 1999.
Back to 99. Yeah.
We talked about interest rates
Yeah.
and how he saw that drop as unsustainable.
Right.
But what did he think would actually happen?
Yeah, what was his specific concern?
Yeah.
Well, if I remember correctly, he was really concerned that those low rates were artificially inflating stock prices.
Yeah.
But wasn't he also worried about corporate profits as well?
He was.
Like something about them being too high relative to the overall economy?
You're exactly right. He believed that those sky-high profits just couldn't last.
Okay.
He even went so far as to predict that the U.S. economy wouldn't grow at a rate exceeding 5% annually.
So he was basically saying that if the overall economy wasn't growing that fast,
Right.
corporate profits would have to slow down as well.
Exactly.
Okay.
And eventually that would put downward pressure on stock prices.
So he was looking at this bigger picture,
The whole picture.
not just individual companies.
Right.
He was saying, hey, even if a company's doing great,
Mm-hmm.
it can still be affected by these bigger economic forces that are happening.
Totally. And he understood that everything was connected.
Right.
And that's why he was so wary of those short-term tactics that companies were using
Yeah.
to boost their earnings per share.
Right. Like we talked about those share buybacks earlier.
Right. Like those share buybacks.
Yeah. He saw those as this way to kind of dress up a company's financials
Yeah.
without actually improving its underlying business.
It's like putting lipstick on a pig.
It's putting lipstick on a pig.
Yeah.
Exactly.
Right. Might look better on the surface, but it's still a pig.
It's still a pig at the end of the day.
Exactly. And it highlights how important it is to look beyond the hype
Yeah.
and to really focus on those fundamentals.
The fundamentals.
Buffett always believed that it was genuine business growth that drove long-term value,
Okay.
not financial engineering tricks.
But wouldn't some people argue that those buybacks were actually beneficial to investors?
Oh, sure.
Like, didn't they increase the value of their shares, at least in the short term?
That's a fair point, and there are definitely arguments to be made on both sides.
Okay.
But Buffett was concerned that those buybacks often came at the expense of reinvesting in the business.
So not putting money back into the business.
Exactly, and that could ultimately hurt their long-term growth prospects.
Right, because you need to keep innovating and growing to stay competitive.
Exactly. He would much rather see companies use their profits to expand operations, develop new products, or make strategic acquisitions.
Yeah, things that actually build long-term value.
Exactly. So it really comes down to this question of short-term gains versus long-term sustainability.
Right, and it makes you wonder if maybe today's market is facing some of those same challenges.
It does, doesn't it?
I mean, we've seen a lot of companies pouring money into those stock buybacks in recent years.
Yeah, we have.
So is that a sign of a healthy market, or is it a potential red flag?
That's a great question, and it's one that we should definitely dig into.
Yeah.
But I think it's important to keep in mind that Buffett was writing this back in 1999.
Right at the peak of that dot-com bubble.
Exactly.
Yeah.
And the market landscape has changed quite a bit since then.
Oh, it's a completely different world today.
It really is.
I mean, back then, everybody was just throwing money at anything with .com in the name.
Right. It was the Wild West.
Exactly.
Mm.
But today, we've got things like artificial intelligence and blockchain
Uh-huh.
dominating the headlines.
Yeah, it's a whole new game.
It is.
Yeah.
I wonder what Buffett would make of all of this.
Right. Would he be skeptical?
Yeah. Would he see these technologies as those automatic losers?
Like he did with the early internet companies?
Right.
Or would he see their potential
Yeah.
to really transform industries
Right.
and create lasting value?
That's the million-dollar question.
It really is.
But before we get too caught up in what's happening today,
Yeah.
let's bring it back to those specific predictions that Buffett made
Okay.
about interest rates, corporate profits, and GDP growth.
Right.
How did those actually play out over the past couple of decades?
Yeah. Did his concerns come true?
Yeah, did his crystal ball actually work?
That's what we're going to find out.
Okay.
It's time to see how those economic forces have actually played out in the real world.
All right, so let's take that trip down memory lane
Okay.
and see how Buffett's crystal ball measures up against reality. All right, so we're going to put Buffett's 1999 predictions to the test.
Let's do it.
Starting with interest rates, he was really concerned about those low rates,
Right.
calling it a sugar high for the market.
Mm-hmm.
What happened there?
Well, it's funny you should mention sugar high
Oh.
because the party kind of kept going.
Really?
Interest rates stayed remarkably low over the past couple of decades, often near zero.
So even lower than that 5% he was worried about.
Yeah, especially after the 2008 financial crisis.
Wow, so that part of his prediction was a little off then.
Yeah, it was.
Mhm.
But it's interesting to think about why,
Yeah, like what happened?
The economic landscape really shifted in ways he might not have anticipated.
Okay.
You had global events,
Uh-huh.
central bank policies,
Right.
technological advancements. All these things kind of came together to keep those rates down.
Interesting. Okay, so what about corporate profits then?
Yeah,
He seemed pretty convinced that they couldn't stay so high
right.
compared to the overall economy. Did he get that one right?
Yeah, he was spot on with that one.
He was.
Corporate profits have been generally healthy,
Okay.
but they haven't kept pace with GDP growth the way they did back in the late 90s.
Mhm.
There have been peaks and valleys, of course,
Right.
but the overall trend has been a lot more moderate.
So the party did eventually end.
It did.
Makes you wonder if those high profits were partly fueled by that low interest rate environment we talked about.
Yeah, maybe companies were borrowing cheaply,
Yeah.
investing in ways that boosted their short-term earnings,
Right.
but ultimately weren't sustainable.
It all kind of ties together.
Exactly. It's all interconnected.
Okay, so 2 out of 3 so far. What about GDP growth?
Okay.
Did the U.S. economy actually hit that 5% annual growth rate?
Not consistently.
Hmm.
There were periods of strong growth,
Yeah.
but the average annual rate has been more modest.
So again, predicting the future
Yeah.
is really tough.
Yeah.
But even though Buffett might not have gotten every detail right,
Right.
it seems like his big message about looking beyond the hype,
Yes.
focusing on long-term value, that still holds true.
Absolutely.
He was telling investors to be skeptical, to question assumptions,
Right.
and to not get caught up in the frenzy of the moment.
They keep a level head.
Yeah. And those insights from back in 99,
Yeah.
they're still relevant today.
Oh, for sure. Think about it.
Yeah.
We're in another period of rapid technological change.
Totally.
New industries emerging, old ones being disrupted.
Yeah. It's more important than ever to be able to figure out what's really valuable.
Why? What's going to last?
And what's just hype.
What's just a fad?
Exactly. And where Buffett wisdom really comes in.
Yeah.
It's not about chasing the next hot stock or trying to time the market.
Trying to be smarter than everybody else.
Exactly. It's about finding those companies with strong fundamentals,
Right.
a durable competitive advantage,
Okay.
and a management team that's really focused on the long term.
Long-term value creation. That's what it's all about.
Exactly. And as we wrap up our deep dive into Buffett's 1999 predictions,
Yeah.
I think it's worth leaving our listeners with this thought.
He was obviously concerned about the shrinking number of publicly traded companies.
Yeah, he used that horse analogy
That's right.
to illustrate that point.
Makes you wonder if that trend's continued.
Hmm.
And if so, what does it mean for investors today?
Yeah. Are there fewer opportunities to find those great companies?
Or are there new ways to participate in the market's growth?
That's a great question to leave our listeners with.
It is.
It's a reminder that the market's always evolving,
Always changing.
and we as investors need to adapt.
We need to keep learning
Absolutely.
and questioning
Yeah.
and investing wisely.
Couldn't have said it better myself. Thanks for taking this deep dive with us.
My pleasure.
Until next time, keep learning, keep questioning, and keep investing wisely.